Warner Bros. Discovery is currently sitting at 27.77 USD. The stock closed with an intraday gain of $0.16 or a rise of 0.58% during the last trading session on Friday, December 19, 2025. It is now Saturday, December 20, 2025, and the market is closed for the weekend. While a 0.5% gain might look quiet on the surface, the story under the hood is anything but calm. Most people expected this company to spend years slowly chipping away at its mountain of debt, but the reality is that we're witnessing one of the most aggressive corporate transformations in the history of media. The biggest shocker for the market lately isn't just the debt reduction, but the fact that the board has officially recommended a massive deal with Netflix to acquire the studio and streaming assets. This move completely upends the narrative that this company would stay as a legacy conglomerate forever. Instead of a slow grind, we're seeing a full-scale breakup that effectively splits the high-growth content factory from the older television networks. The common belief among investors for the last 2 years was that the debt load would cap the upside for a long time. People thought that as long as cable television was shrinking, the stock would be stuck in the mud. However, the contrarian view that is now becoming the mainstream reality is that the content library is actually the ultimate currency. When you look at the recent price action, the stock has surged over 160% this year. Much of that came in a massive wave this month as the bidding war between Netflix and Paramount Skydance reached a fever pitch. The board recently rejected a $108 billion hostile bid from Paramount, choosing instead to go with the Netflix offer valued at $27.75 per share in a mix of cash and stock. This creates a fascinating floor for the price, yet the market is still trading slightly above that offer, which tells you that traders are betting on either a sweetened deal or a very smooth transition into the next phase of the company's existence. Looking at the institutional activity, there's been a significant shift in who is holding these shares. Large players like Vanguard and BlackRock have maintained their massive positions, but we have seen aggressive new entries from firms like Apollo Management. When big private equity and institutional heavyweights start increasing their stakes by 30 or 40% in a single quarter, they aren't looking for a quick trade. They are positioning for the structural separation of the business. If you're using an individual brokerage or even a simplified platform like the Robinhood app for your Robinhood investments, you might see the volatility and feel uneasy, but the big institutions are looking at the math of the good bank versus bad bank split. They see the streaming segment, which recently hit $1 billion in profit, as a high-growth asset that was being unfairly dragged down by the debt associated with the linear TV channels. If you are currently managing your own portfolio through interactive brokers or using the Fidelity mobile app to track your holdings, the recent volume on this stock has been staggering. We are seeing tens of millions of shares trade hands daily as the market digests the news of the Netflix merger. For those involved in self-investing, the tension between the current price and the $27.75 offer price is where the opportunity lies. Is there more room to run? Some analysts have already pushed their targets to $30, suggesting that the sum of the parts is actually higher than what Netflix is paying. This is especially true when you consider the value of the Discovery global entity that will be spun off to shareholders. That new company will hold the cable networks like CNN and TNT, and it will be unburdened by the studio costs, potentially becoming a cash-generating machine for those who stay through the split. The daily swings we have seen lately are a reflection of the regulatory landscape. While the board wants the Netflix deal, there is always that lingering question of whether the government will allow the biggest streamer to buy the biggest studio. This uncertainty is what keeps the stock from shooting straight to $35. However, the reality of the business model is that the company has already done the hard work of cleaning up the balance sheet. They've paid down over $20 billion in debt since the merger. That kind of financial discipline is rare in Hollywood. It is why the stock finally broke out of the single digits and is now flirting with the high 20s. It's a classic case of the market finally rewarding a management team for doing exactly what they said they would do, even if it took 3 years of pain to get there. Comment below how many shares of Warner Bros. Discovery you currently hold, or if you are planning to sell before the Netflix deal closes. Your input helps everyone understand the retail sentiment versus the institutional moves we are seeing on the major investing sites. When we break down what the company actually does, it's helpful to view it as a content warehouse. They own the DC Universe, the Harry Potter franchise, and HBO. For a long time, the business model was to use the cash from cable TV to build out a streaming service that could rival the tech giants. The old reports showed billions of dollars in losses during that build phase, which is why the stock price was decimated in 2022 and 2023. But the most recent quarterly reports showed a massive swing into the black. Streaming is no longer a drain, it is a contributor. They have over 128 million subscribers globally now. The strategy shifted from chasing volume at any cost to focusing on profitable growth. This shift is what made them an attractive target for a buyout in the first place. They proved that they could make the math work in a world where everyone else was still burning cash. The sector momentum is also working in their favor right now. As the broader market looks for value away from the massive tech names like Nvidia stock or Apple stock, media companies that have fixed their balance sheet are becoming the new favorites. Investors who use Schwab Intelligent Portfolios or other automated tools for online investing are seeing their allocations shift towards these recovering value plays. It's a rotation out of pure growth and into companies that have actual earnings and a clear path to returning capital to shareholders. The microeconomic pressures of higher interest rates actually forced this company to be more disciplined. While other studios were still spending wildly, this management team was cutting costs and focused on free cash flow. That discipline is now the reason the stock is performing so well while others are still struggling to find their footing. If you are currently managing your own trading through a Fidelity platform, or perhaps exploring the SoFi trading platform, you will notice that the volatility in this stock is significantly higher than the average. It has a high beta, meaning it moves much more than the S&P 500. This is great for active traders, but can be nerve-wracking for long-term holders. The reality, however, is that the downside risk has been significantly mitigated by the buyout offers on the table. It's very hard for the stock to fall back to $10 or $15 when there is a standing offer to buy the core assets for nearly $30. This creates a unique risk-to-reward profile that you don't often see in the media sector. It's almost like having a built-in insurance policy on your investment while still having the upside if a better bidder comes along. Looking toward the future, the catalysts are very clear. First, we have the shareholder vote on the Netflix merger. Second, we have the regulatory review process, which will likely take most of next year. Third, there is the planned spin-off of the linear networks in late 2026. Each of these events will create new waves of expectation and reality. The risk is that the deal gets blocked, which would likely cause a sharp, temporary drop in the stock price. But the opportunity is that even if the deal fails, the company is now a profitable, leaner entity that can stand on its own or look for another partner. The Bad Bank spin-off is a major opportunity. Many investors hate cable networks, but they love the dividends those networks can pay when they aren't being used to fund expensive movies. That spin-off could create a whole new class of value for anyone holding the stock through the transition. In terms of the technicals, the stock is currently trading above its 50-day and 200-day moving averages, which is a very bullish signal. The trading volume has been consistently high, indicating that this isn't just a retail pump, but a sustained institutional accumulation. If you are using SoFi Active Investing or a similar service, you can see that the sentiment has shifted from avoid to buy across the board. The analysts who were screaming about the debt 2 years ago are now talking about the streaming powerhouse that is being created. It's a reminder that the market narrative often lags behind the financial reality. By the time the news is obvious to everyone, the biggest moves in the stock price have often already happened. This is why paying attention to the balance sheet changes 6 months ago would have been the key to catching this 160% run. If you are using Interactive Brokers platform to manage a more complex strategy like options, the implied volatility is currently quite high. This suggests that the market is expecting more news or a potential counteroffer. While the board has recommended Netflix, the presence of Paramount and other potential suitors like Comcast in the background keeps the tension alive. This is exactly what keeps viewers and investors hooked. The expectation is a clean merger, but the reality could be a multi-party bidding war that drives the price even higher. For someone using Robinhood fractional shares to build a position,